right, ladies and gentlemen, welcome to TLDR, Too Long Didn't Read Finance Edition. And I'm your host, Matt. Thank you for joining. I'm going to talk about options today. Staying simple, going long, or purchasing options, either to the downside in the respect of put options, or to the upside in respect to call options. So here is the initial TLDR piece. So some things to focus on, of course. Max loss is just the premium we paid, and we're going to show some examples of premium and how to see it, how to calculate it. So losses are limited. Maximum gain can be quite large, and for put options there is technically a limit because stocks can only go to zero, but with call options stocks can go up forever, so technically an infinite theoretical maximum gain. Stocks give you control over 100 shares of stock. We're going to talk about that a bit more as well. Highly leveraged. That's why I think a lot of people fall in love with options, but also why a lot of people are scared of options, or I'm never going to use them, they're too risky, etc. But my hope is to just educate you a little bit here and help you out with why they can be a great tool when used correctly. And then of course the price of options is derived from underlying stock. So here's the snapshot of put options. We have a quick visual, which we're going to show some bit more here as well. But ultimately, you have your share price going across the middle here. So as the price goes up of the stock, your put option, again, puts are bearish. We want the stock to go down. So if the stock goes up, we are going to lose money and ultimately lose our maximum amount, which is, again, the premium paid. If the stock price goes down, our put option goes up in value. And then, of course, the strike price is the price we pick. More on that later. Our snapshot for call options. So very similar to put options, except, of course, calls are bullish. Maximum loss, again, is the same, premium paid. Maximum gain, again, I said technically can go up forever, theoretically, because options or stocks underlying can continue to go up forever. There's no zero. As with puts, we can't go negative, so zero is the limit there. All right, so we're going to get into, in the visual here. Again, call options, pretty much the mirror image of the put. As the stock price increases, our value of the option will increase. As the stock price decreases with a call option, we will lose money up to our premium paid or the maximum risk. So with call options and put options, they are the beginner level, I would say. Most option firms or retail brokers that are allowing for options, the standard or simplest level to get approved for is covered calls, which we'll talk about later, and cash secured puts. That's because technically the level of risk is less to the firm and to the client in some respects. However, the easier piece to understand, I would think, is just buying the call or buying the put outright. So that's why I'm starting there. It may be level 2 or slightly above the minimum threshold for options at certain firms, but these are going to be the easiest, I think, to explain. So again, back to put options first. First and foremost, you're looking for when you're purchasing, because with options we can go short and sell the option. And think of it as the house in Vegas. So you would be the casino when you're selling options. More on that in another video. Today, though, we're buying options. So these, are sometimes called lottery tickets or gambling because it has the potential for high returns. And because of that, and because you can technically get them for very inexpensive amounts of money, people like to think that that makes them risky, or lottery tickets because you don't win very often, but when you do, it can be a big reward. And so we'll talk a little bit about that and deciding based on really the strike price, how you can be correct more often, or obviously, but it's a trade-off. If you're right more often, the reward is going to be smaller. If you're choosing less percentage chance to win or less probability of profit, then it's going to be an inverse there. So if you're willing to risk more in the sense of a higher or a lower percentage chance of being correct, you could potentially make a much larger premium or a much larger premium payout at the end, a reward, than say a higher percentage chance of being correct um, with the same option. So, and we'll talk about in that. In a term there is one of the Greeks. So there are a couple of Greek letters when dealing with options. And again, another video, but we will talk about delta today, and that will help us understand this percentage chance of being correct. So we've got, again, max loss, so premium paid. That's why these options are also kind of a newbie's best friend or beginner's best friend, is there's a maximum that you can lose. So you put 1,000 in. Everyone's worry when they're dealing with options or with margin is that I don't want to lose any more than I bet, than I wagered, than I deposited to the account. With long options, puts or calls, you can make sure that you don't lose more than you have. Max gain, again, big deal there. That's why it draws a lot of people. You'll see a lot of YouTube videos or people claiming huge returns for a small amount of money, and it's usually done via options because of the leverage factor. And we'll talk more about that with the visual coming up here. So each option contract is standardized, or a standard contract, in that it has every equity stock option traded on a major exchange has 100 share multiplier or equivalent. So each contract, a single option contract, gives the owner, the purchaser, control of 100 shares of the underlying stock. So if I have ABC stock or an ABC option, and that I technically have control because I can exercise at any point. Now, it's not always smart to exercise depending upon where the underlying price is, but I have control. I can exercise that for 100 shares of stock. Now, it's gonna charge me more money. I'm gonna need to pay for those 100 shares at that time if I want to execute them or exercise them. However, the minimum amount for the option itself, for the paper that says that I have control, the contract, if you will, is very reasonable and much less than the actual full payment of 100 shares of stock. They're used for speculation and protection. So put options are usually people's first thought for protecting against a downside move. Most people think the stock market only goes up, or they have a aversion to betting on going down or betting against someone else, or profiting if the market were to go down. So they'll look to put options to protect their portfolio, which is usually very long biased, very up and to the right directional, very heavily stock weighted, and so they have a lot of risk on the table if a March event here in 2020 or a COVID situation or any of the different news generated or market generated dips or drops or depressions happen, they look to put options for protection. They can also be speculation because there are people out there that want to profit when things go down, and so you can do that with put options as well. Stocks or calls options, excuse me, can also be done for speculation and protection. Protection, probably more so if you are wagering on a short play. You're expecting the stock to go down, so you've shorted the stock. You're buying a call option for protection in case it does go the other way and does go up, which would be bad if you were short the stock or if you were expecting it to go down. Typically, call options, though, I would say, are more on the speculation side. People think some ABC company is going to do good for earnings, so they buy a call option because they don't have a lot of funds available to buy enough shares of stock to make it worthwhile. But because of the leverage and the 100 multiplier of an option, you could buy a single option for the same amount and get a much higher return, assuming your prediction is correct. So we're going to switch over to the trading platform now. So I happen to use Thinkorswim on TD Ameritrade, big fan. But what you need to know is that what we're going to show today is the option chain. So this whole thing is called an option chain, and I'm going to show you how to read it, and then also how the multiplier works for the 100 shares, as well as the delta and how we can see the cost in that and how much our percentage chance of being correct might be. So just because we're talking about ABC stock, it is actually a stock, so I didn't mean that to happen. And of course, I'm not saying that any of these are predictions or suggestions or advice on stocks to buy or sell. These are purely examples, so definitely do your own research for that. But in this example, we'll stick with ABC. And so an option chain, so again, if you're using Thinkorswim, again, you don't have to, any platform, the website for TD Ameritrade, Charles Schwab, all that will have a similar layout in the sense of, they probably call it option chain. There is a center strike component. This is our strike price. We have an expiration, and as you see, there's the December 4th here and a bunch of different dates out. Typically, options can go out to about 2 years and may have weekly expirations, so every Friday, or just monthly expirations, which are all the gray items here on this particular platform. Left side is typically call options. Right side is typically put options. And so again, in this example, ABC is trading at 102 as of the close today. So this is the evening, so it's not trading currently, but that's fine for our example. So at the money would be the 102 strike for calls or puts, because the stock is currently trading at 102. So at the money is the 102. Out of the money for calls would be anything above that, because again, it's this shaded area here. But also we know it's out of the money because it's above the current price. The opposite for puts, the put side below the strike, the at the money price, is the out of the money. Then of course, after the line here in the sand of 102 for puts, if it's the price is above as far as the strike here, so if we had the 108 puts and the strike is and the price of the underlying stock is currently at 102, these 108s would be in the money, similar to the 98s over here on the call side. So on, let's say we think ABC is going to go up over the next 3 days, because with options, especially calls, long and puts, we have 3 pieces of data or choices that make up the majority of are we going to make money or not. And that is strike price, which one of these prices do we choose? Direction, is it going up or is it going down? And then in what time frame? So if we think it's going up, but it doesn't go up until 10 days from now, well, our choice on the call options for this Friday are going to expire worthless, and they may not have any value at the end of the week. But I think we'll dive into that for another day. But just know that time does matter. In this example, we've got a crystal ball. We know ABC is going to go up a couple dollars or go up to some value by this Friday. So we want to buy a call. And now if you buy the 145, and I just did that by clicking on the ask, comes up here as our order ticket. It's explaining the December 4th, the 102 strike. We want to buy a call. We want to buy one of them. And at 145, I'm not going to send this, but I'm just going to pull up this piece here because it's going to show us, it's going to cost us $145 plus 52 cents, because that's what they charge for an option contract. But this 145 number, because again, look up here, 145 was the contract listed. However, we have those 100 shares of stocks. We have that 100 multiplier for all options. So it's 145 times 100, or if you like to think about it, times 100 shares. That's why this option is going to cost us $145. Now, if we were to buy that, this would give us a 53% chance of being in the money by at least a penny, so profitable by 1 penny at expiration. And so, excuse me, so it's actually 53% chance that this contract has 1 penny of value at expiration. Doesn't mean that we necessarily are profitable, but it does mean that this contract, 53% of the time, based on the formulas, either Black-Scholes or some crazy German name, Bjergsen Stenslen, but we can choose between the two. Black-Scholes, binomial, 3 now. But based on that math, which is tried and true for most of the market, 53% of the time this contract will have some value at the end of expiration. Usually at least a penny or more is how they could do that. So if we want to increase our chances of being right, then we need to go further in the money as far as call options. We've got our 285s. If we go down to the 100s, now we have a 76% chance of being correct. And again, what that's doing, and we'll talk about, there is a tool on this platform to show you theoretically or theoretical value at the end of the 3 days here on Friday if we thought it was going to move X amount, but that's another video. But what I want to show you here is just purely delta. So if we go down 2 more strikes, it's going to cost us almost twice as much, but we are now 76% chance of having value at the end of the expiration. So it increases our chances of being correct, but it can reduce our risk reward. So similar to the put side, again, we'd buy the 102, it's going to cost us $125, and we have a 47% chance of being correct. And the reason is it's just the inverse. These two combined equal 1, and that's how you get everything is off of 1. And so if there's 53% chance to be right on the call side, you buy the same put on the other side, it's going to be a 47, 1 minus 53, 47%. So that's a lot, but I think with the, again, to wrap up, initially you have the max loss on these options. They're highly leveraged. They are simpler, or the simplest form of option trading, I believe, with you just buy them, you can, you pick a direction, you pick an expiration, you cannot lose any more than you put into the account. You can have potentially massive gains for it. Again, lower potential of hitting those gains, lower, high reward, low percentage chance of getting that reward. And then of course they can be used for speculation and protection and a myriad of other things, especially when combined into spreads and complex option orders, iron condors, jade lizards, that sort of thing, but we'll get to that another time. But that's it for today. Thank you so much for coming to TLDR, and I'm your host, Matt. See you next time.